In this next section, we'll be looking at inventory gains and losses, and this is the situation when the physical count of inventory does not match the records. In our first scenario, we have in our records 20 units of inventory on hand. When we did a physical count of the inventory, we have counted 20 units that we have on our shelves. In this case, there are no issues here. In our second scenario, in our records, we have recorded 20 units of inventory on hand. But when we did a physical count of the inventory on our shelves, we've only discovered that we have 18 units. In this case, we have an inventory loss of 2 units. In our third scenario, we also have 20 units of inventory in our records. But when we did the physical count of the inventory on our shelves, we have counted 21 units. And in this case, we have an inventory gain of 1 unit. Here are some of the causes of inventory losses and gains that we should be taking note of. First, we're going to record the inventory losses using the identified cost method. So here in our inventory card, we can see that we should have a balance of 8 units at a cost price of $10 and 12 units at a cost price of $15. However, when we did the physical count of our inventory, we have found that we only have 7 units at a cost price of $10 and 11 units at a cost price of $15. Therefore, we need to adjust our records to match up with the number of units that we've counted in our physical count. So what we do is in the inventory card, we firstly write in the balance column the actual number of units and the corresponding cost prices based on the physical count of inventory that we've done. Then we put through the adjustment, and because we can see that there was a decrease of the number of units from 8 units to 7 units, therefore there was an inventory loss of 1 unit at a cost price of $10, and this is recorded in the out column. For our other batch of inventory, we also have a loss of 1 unit at a cost price of $15 per unit to give us a balance of 11 units at a cost price of $15. In total, our inventory loss works out to be $25. The main idea in recording inventory losses using the identified cost method is that all losses of the inventory are clearly identified. In the inventory card, we can see that we have a loss of $25. This is recorded in the general journal by debiting $25 to the inventory loss account. The reason why this is a debit to the account is because inventory loss is an expense to the business. On the other side, we credit $25 to the inventory account to show a decrease in the inventory. Now we're going to record the inventory gains using the identified cost method. So in our current records, we can see that we should have a balance of 8 units at a cost price of $10 and 12 units at a cost price of $15. But in our physical count, we have found that we have 10 units at $10 and 13 units at $15. So the first thing that we do is to update the balance to show the number of units and the cost prices based on the physical count that we have done. Then we recognize the inventory gain by recording in the in column. And here we have an inventory gain of 2 units at a cost price of $10. And we also have an inventory gain of 1 unit at a cost price of $15. The total inventory gains works out to be $35. So the main thing that we need to remember here is that when we are using identified cost method, all gains of inventory are clearly identified. Here we have an inventory gain of $35 as shown in the inventory card. We record this in the general journals by crediting $35 to the inventory gains account. As inventory gains is a revenue to the business, this is why we credit the inventory gains account. When we use FIFO to record inventory losses, we need to assume that we've lost the older inventory on hand. So here in our current records, we can see that we should have a balance of 20 units, with 8 units being the older batch. When we did the physical count, we have found that we only have 18 units on hand. So because we are using the FIFO method, we are assuming that we lost the older inventory. So here in this case, we record the loss in the out column of the 2 units at a cost price of $10. This gives us a new balance of 6 units at a cost price of $10. We bring forward the balance of our newer batch as it is because there wasn't any loss from that batch. So our total inventory loss works out to be $20. Now we record the inventory loss of $20 by debiting the account in the general journals. When we are recording inventory gains using the FIFO method, we need to refer to the latest cost price in the in column. As you can see in our records, the balance column shows that we have 20 units on hand. However, a physical count done on the 30th of June revealed 21 units on hand. This is an inventory gain of 1 unit. To record this inventory gain, we need to look at the latest cost price in the in column. In this case, it is $15 per unit. Therefore, we record this inventory gain in the in column of the 1 unit with a cost price of $15 per unit. We then update our balance to show 13 units at a cost price of $15. There were no changes to the other batch, and therefore we bring the balance down, which shows 8 units at a cost price of $10 per unit. Here we can see from our inventory card that the total inventory gain was $15. And here, the inventory gain of $15 is credited to the inventory gains account in the general journals. In the income statement, inventory losses or inventory gains are reported just after the gross profit, and therefore this will allow us to calculate an adjusted gross profit amount.